All attendees are in listen-only mode.
Good morning, and thank you everyone for joining today's presentation featuring an audit and accounting update. Before we get started, just wanted to go over a couple of quick ground rules for today's webinar presentation. All phones have been placed on mute for the duration of the webinar. Should you have any questions throughout, feel free to put them in the questions tab, and we'll try to get to those questions as time permits. Additionally, if you are attending this webinar for CPE, you will need to answer the polling questions that come out throughout the webinar. There are 4 of them total. So please answer those polling questions that you will need as a requirement for the CPE credit. At this point, I'd like to introduce today's presenters. First off, as an industry leader of our educational institutions group, Marcus Harwood has extensive experience in serving a wide range of industries with a specific focus on education, healthcare, insurance, and foundations. Working with colleges, universities, independent schools, hospitals, and long-term care facilities, Marcus interacts with business managers, audit committees, and board of trustees, and is responsible for audit planning, field work, and supervising staff. In addition to overseeing audit engagements, Marcus performs acquisition-related due diligence procedures. Marcus is also a member of Bloom's Process and Controls Consulting Group, where he provides services such as Sarbanes-Oxley compliance, corporate compliance, and assessment of business risks. Next up is David Nowacki. As a director at Bloom, David has over 18 years of combined experience with management advisory and information security. He has worked with both government agencies and private businesses in setting strategies, reviewing and assessing operations, governance and enterprise risk management practices, project and program management practices, information security programs, and identifying process improvement opportunities. David is an integral member of the firm's risk advisory group, specializing as well in cybersecurity services. At this point, I'd like to hand it over to David, who's going to kick off our presentation with a quick cybersecurity update for us.
Thanks, Jared. Yeah, I think this is one of the most important topics, I think, from a organizational perspective, just due to the trajectory in the types of attacks that your organization may be facing, and it's been like this for years, but it still continues. It's not a matter of if you will get hit, but when, and how prepared you can be to adjust to or respond to the attack, as well as minimize the harm, be it monetary or operational. And so we're going to talk a little bit about some of the items that have evolved over time and what that may look like this year. So if you could advance the slide, Jared. So attack vectors, this is the way that cyber events could impact you, and think of it as the path that a external threat may infiltrate your organization. And so here's a broad set of them, and it's no longer a hacker that's trying to attack you, hack your network. I mean, that's still prevalent, but typically, using people and persons to socially engineer or engage with is the most prevalent attack vector. And look at upper left there. It's text messaging or smishing. It's getting you to respond to something via click. And we saw a lot of this, especially during this election season. A lot of text smishing operations where they're sending you false texts that on behalf of election committees and on candidates and things like that, just to get you to respond. Email phishing has been around for about 10 to 15 years. It's going to continue to be around, where they're trying to get you to share credentials or to click on something, download a piece of malware or something like that. Mining social media. This helps with the bottom two when it comes to gathering information about you so that they can target you or pretend like they're someone who is legitimate that knows something about you and engage with you to again, provide your username, password, possibly download malware, or even send information out the door, whether it's a wire transfer or financial transaction, or it's it's something like a W-2 file that we're going to start to see as we progress to tax season. So if we could advance to the next slide. one of the things that we're seeing extreme growth in is ransomware. And what ransomware is it's a piece of malicious software that you may click on an email and it will install in on your computer systems, and it may end up propagating into your servers and cloud environments, as well as all of your desktops, laptops as well. And so ransomware is one of those things where they take control of your network, they encrypt your files so that you can't recover them, and they ask for you to pay a ransom in order to decrypt them. And so, two bullets there at the top. Ransomware as a service it's a full-on industry, it's a full-on operation. And so there are bad guys that can buy into ransomware as a service schemes. So basically, they don't have to set it up themselves. They don't have to be highly technical. You just fund the operation and get a portion of the ransoms that are collected. The stat there, every 39 seconds there's a hacker attack, and it's probably even more frequent now than when this study came out at the beginning of the year. I think we've seen an exponential increase with all of the COVID-related remote access and opening up networks and pushing things to the cloud. I think everyone is a target now. Targeting small businesses, government entities, schools, and other educational organizations, it's prevalent. There's an exponential increase in that as well. And since COVID-19, you see the stat at the bottom, 300% increase in cyber crimes. And all of these carry a pretty significant monetary impact of that. Next slide, please. Among the most the most important things you can do is raise awareness and be prepared. So 95% of cybersecurity breaches are due to human error. That's someone who's acting in good faith, clicking on the wrong email, or replying to an email, or forwarding an email to others in the organization and propagating the threat or the malware. Most organizations don't have an adequate incident response plan, meaning they know when they get hit, but they don't know what to do with it. And so you end up calling external resources for help, and that ends up spreading out the timeline to respond or contain the virus. And basic controls like detection controls and monitoring your systems for potential breaches. Most organizations don't know for months that they've been attacked or breached. And I think that one of the scarier things out there is just the propagation of non-traditional devices and IoT devices, smart home devices, your Amazon Alexas, your smart cameras, your smart TVs, smart coffee pots. This is going to expand significantly for both organizations as well as individuals as you work at home, throughout the COVID pandemic and into the future. And so, there will be so many more devices out there, all of which need to be protected, secured, patched, and all of which could represent some form of a target. If you want to advance to the next slide. Ransomware attacks. It's one of the evolutions on this type of attack. It used to be, going back 6, 7, 8 years ago, they were just out there to obtain money and playing the numbers game, meaning they would encrypt it. And if you did pay, great. If you didn't, they move on to the next attacker. And people got smart and had reliable backups, and they could say, no, I'm not paying the ransom. I'm going to, restore from backup and just ignore this. Well, now these attacks are extracting information before it cripples your network. So their first step is to make copies of your data out to the dark web, and or a website that's like a marketing website for bad guys to go out and buy and steal your data. And so they will threaten to publish that data. And it's the concept of double extortion, where they're trying to coerce you into paying the ransom. They want your money, and they want everyone's money. And it's not just the numbers game anymore. They're targeting organizations. They are engaging with you. And if you don't pay the ransom, they're going to threaten to spread your money all over the dark web. And so this has greatly increased the cost of a ransomware incident. It's probably threefold what it was a couple years ago, just because they're engaging with organizations and forcing them to pay the ransom. And so the monetary impact as well as the operational impact is not going away anytime soon. And so I will say thank you for allowing us to talk about cybersecurity, ransomware, and some of these threats you're likely to see in this year. If you have any questions about this, we can certainly, it's not the primary focus of this webinar, but we can certainly answer your questions later on if you will submit that via our contact information. Jared, if you want to advance the slide.
Perfect. Thanks, David. We'll now hand it off to Marcus Harwood to begin his part of today's presentation.
All right. Thanks, Jared. And Dave, it's always unsettling to hear you speak, but I would say that the message is clear. The trends are all moving in the wrong direction with respect to cyber risk exposure. So if you're not sure what your security stance is or haven't recently conducted a cybersecurity assessment, no time like the present. So, and with that, we're going to spend the remainder of the discussion talking about some of the financial reporting considerations and internal control considerations as we work through this pandemic and think about closing the books for you, those of you who are 9/30 or 12/31 calendar year ends. So moving forward, Jared. First thing to be aware of is that back in the spring and summertime, as part of its COVID relief efforts, the standard setters, the FASB, delayed certain standards in order to relieve the administrative burden. So the two biggies, revenue recognition, that was effective for calendar year ends December 31st, 2019. Effectively, it was pushed out during the springtime. So anybody that hadn't issued statements yet had the option to defer to 12/31/2020. So if you took advantage of that deferral, hopefully it provided some relief over the summer, but be aware that it is now upon you, and make sure that you've got a plan. Implementation can be complex, so make sure the analysis has been performed and you've got a dialogue open with your auditors to ensure that everybody's on the same page. The other major standard that's been out there for some time is the lease standard. And for all private companies and private nonprofits, the implementation date has been pushed back effectively to calendar year end 2022. If you are a nonprofit with publicly issued debt, it would be effective for this upcoming calendar year, 2020. So next slide, Jared.
All right, we got a quick poll question break here. Just as you're getting started, Marcus, we got a quick poll question break for CPE here. So I'm going to launch this question, and we'll leave this up for about a minute here for everyone to get their thoughts in. Again, if you are attending for CPE, you are required to answer the poll questions to get that credit. Just going to keep it open for another 10 to 15 seconds here, and then we'll move along. Perfect. Thank you, everybody. Back to you, Marcus.
All right. So PPP loan forgiveness. This is it's guidance or lack thereof with respect to PPP accounting and loan forgiveness continues to evolve. We had a portal open so that people had the opportunity to submit questions prior to the webinar. And I will say that almost all of them, probably 95% plus, related to PPP accounting and loan forgiveness. So I will try to cover some of those questions during this portion of the presentation itself. To the extent that I haven't covered them, I will address a few at the end of this section. There are others that are very sort of detailed mechanical in nature with respect to completing the forgiveness application, what constitutes an FTE, that sort of thing. And you know we've done other webinars specifically on that topic that can take over an hour just on itself. So what we're going to do with those questions is that we will work with our team that's dedicated to assisting clients with calculating PPP loan forgiveness and preparing the application. We'll be back in touch with you, but it's beyond the scope of what we're going to be talking about right now. So So accounting for forgiveness. Fundamentally, a forgivable loan is a form of government assistance. And the challenge here is that while there are standards that guide nonprofits in accounting for government grants, there is no guidance that applies directly to for-profits. And so in that vacuum, there's a few alternatives that have evolved. And the guidance really has come from the AICPA. The FASB has not weighed in definitively on this, but I think that at this point there's sort of a broad consensus that there are 4 models that are available and appropriate to apply. The first is debt. The second is, and anybody can account for a PPP loan as debt. The second is a government grant model, which anybody can apply. The third is government grant under International Accounting Standards 20, and we'll talk briefly about that. It's not available to nonprofits since there is US GAAP that nonprofits can apply, but it is in theory applicable by for-profit entities. And finally, gain contingency. We'll speak briefly about that as well. So first of all, debt. Again, as I said, anybody can apply debt accounting model for the PPP loan. The reason for that is that the underlying instrument is a loan payable to a bank. And so there's a safe harbor that anybody may elect this. That's true whether or not you intend to seek forgiveness for the note. And if you choose the debt model, you would record the proceeds when you receive the cash, and the liability would be debt on your balance sheet. Moving forward, and then upon forgiveness. So when does forgiveness occur? When you are applying the debt model, forgiveness is a function of being legally released from your obligation by the lender. So that may be a while. Keep in mind that the measurement period for forgiveness may be up to 24 weeks from the time that you receive the proceeds. You then have 10 weeks to submit your application. The bank has 60 days to process and review and approve the application. The SBA then has 90 days to review and approve. So it's almost certainly going to be a 2021 event if you're a 12/31 calendar year end. So that amount would remain on your books as a liability until it's extinguished, which would likely be 2021, at which point it would be recorded as a gain on extinguishment. So that is the point in time when the bank, the lender, has released you from your obligation, which would be after the SBA has approved the application. So next slide. If you elect the government grant model, and this certainly applies to any nonprofits, but also for-profits. Any non-governmental entity can elect to account for the PPP loan proceeds as a government grant, which essentially means it's a conditional contribution. So when you receive the proceeds, initially there would be a liability recorded. It would generally be classified as either deferred revenue or a refundable advance on the liability side of your statement of financial position. Slide. So upon forgiveness, you would record the contribution income. So using the government grant model, income is recognized as the barriers to forgiveness are overcome. So that leaves some room available for where you'll have to determine what those barriers are included. But generally speaking, the barriers would include the qualifying expenditures that are incurred, and that's primarily payroll, rent, utilities, the allowable expenditures, as well as maintaining certain levels of FTEs and salaries during the measurement period. The question is, what about the fact that I need to be approved by the bank and by the SBA? And I think there's a position that can be taken that those are administrative exercises in nature. They're not core barriers to be overcome, and they wouldn't preclude you from recognizing the revenue. Although, if you determine that some of the issues surrounding forgiveness create a level of uncertainty about whether any barriers have been overcome, you may elect to defer revenue recognition. One final note with respect to overcoming barriers: you do not consider the likelihood that you'll overcome barriers that have not actually been met as of the end of your fiscal year end. So what that means is, suppose you're a September 30 year end and you elect a 24-week forgiveness period, which straddles your fiscal year end. you can't take credit in your calculation for FTEs and maintenance of salaries during periods after your September 30 year end. So there's likely to be a bit of a haircut, so to speak, on the amount of income that you would recognize in that situation. But if you're a 12/31 year end, you're likely to have concluded the measurement period prior to calendar year end. As you can see, there's likely a path available for you to determine whether it makes more sense to recognize revenue during fiscal year 2020, accounting for it as a government grant. Some or all of it will likely have been forgiven based on this overcoming the barriers model, or deferring that revenue recognition and the recognition of the gain on extinguishment until fiscal year 2021 under the debt model. So the key is to be aware that you have those accounting policy elections. Either one of those is appropriate. So moving ahead, the International Accounting Standards 20, and the reason this is thrown out there as available to be applied by analogy if you're a for-profit is because there is no US GAAP, as I said, that applies directly to for-profits, and so this is intended to be a mechanism that's allowable by analogy. And it's a very similar model to the government grant model. It's a bit more flexible. And if you flip to the next page, Jared, the primary difference is, whereas, as I mentioned in the government grant model under US GAAP, you can't consider any barriers overcome until they actually are overcome, whereas under the IAS 20 model, you may record revenue when there is reasonable assurance that forgiveness will occur. So there may be some more flexibility, particularly with respect to those situations where your forgiveness period straddles your fiscal year end. If it's probable that you're going to have forgiveness based on the expenses that were incurred prior to year end, there's a bit more flexibility here. But again, that would result in some contribution income being recognized during the current fiscal year, some or all. Next slide. And the last model that's available is considering the forgiveness to be a gain contingency. As a practical matter, that's not very different from the debt model. Gain contingencies are recognized when they are realized or realizable. That's very likely to be very near the point in time when you're legally released by the lender. So not much difference there as a practical matter from the debt model. I'm just going to pause here for a moment and address a few of the questions that came in about the PPP loan forgiveness. So the first is, what will accounting revenue treatment be for PPP loans that are forgiven, recognized in 20 or 21? We've addressed that, I think. But then it goes on, if 100% of the loan is forgiven, can taxes paid on these forgiven loans be avoided? So that's an important question. That it's a sort of confusing mechanism where the taxability of loan forgiveness comes into play. It's not the forgiveness itself that's taxable. So it doesn't matter whether you elect the government grant model and potentially recognize 100% of the revenue in 2020, or the debt model and recognize 100% of the income upon, or whatever portion is forgiven upon extinguishment in 2021. That has no bearing on the taxability of PPP loan forgiveness. What does matter is the expenses that result in forgiveness. To the extent that those expenses are incurred during fiscal year 2020, they are not deductible for tax purposes during 2020. So that's where, a sense, it's non-deductible. Once they become non-deductible, that's where you get the tax hit. And that's a fact whether or not you recognize the income in 2020 or 2021. It's a function of when the expenditures are incurred. So we've been hearing all summer long, and we continue to hear that there may be legislative relief that would, that would cure that tax exposure. And hopefully it'll happen, but in the meantime, the IRS's stance is clear. Their interpretation is relatively black and white, that those expenses that are funded by the PPP loan are not deductible for tax purposes. So absent legislative relief, that's the facts as they stand. So the next question was, what's required for loan forgiveness not to be taxable? An act of Congress? Essentially, yes. And it's not the forgiveness per se, but the deductibility of the non-deductibility of the expenditures. We got another question. If we spend less than 75% of the money received on payroll-related expenses, can we still qualify for partial forgiveness? And the answer is yes, but be aware that that 75% was reduced to 60%, and the 8-week measurement period you have the option to extend to 24 weeks. So both of those initiatives were undertaken to increase the likelihood that you'll be able to achieve full forgiveness. But if you fall short of those benchmarks, there is a prorated amount of forgiveness based on the actual qualifying expenditures that you absolutely still could achieve. Next question, if a school borrows more than $750,000 under this program but has no other federal funding, does it then fall under Yellow Book? So the question there is, does PPP proceeds trigger A133 compliance audits? And the answer is no. No matter how much the loan is, what it could be millions of dollars, the PPP loan program is exempt from A133 compliance audits. So that's great news. That's not true if you received other federal funds. So if you're a healthcare provider, for example, that received money under the Provider Relief Fund or funds administered by HHS, those funds are subject to A133 audits, but the PPP loan is not. For your 2020 tax returns, how do you handle 2020 PPP loan and forgiveness approved expenditures? So if you don't record the revenue, and again, the expenditures are non-deductible regardless of when you record the revenue. By when does the money have to be spent? Is there any chance of additional money? So initially the money had to be spent, the expenditures had to be incurred during an 8-week measurement period following receipt of the funds. That was extended to 24 weeks. Right now, that's the extent of it. Is there any chance of additional money? There's a chance. It depends if Congress can get itself together. There continues to be talk about it, how substantial it will be, and how might it be targeted differently than PPP is anybody's guess at this point. Are the banks accepting forgiveness applications? A lot of them are. There may be a few that still think there's too much uncertainty and exposure to open their forgiveness portals. But at this point, I think quite a few, if not most banks, are accepting forgiveness applications. And accounting for PPP loan forgiveness, including timing, must we wait for SBA approval if it seems that won't happen until 2021? I guess that depends on whether your interpretation is that SBA forgiveness is administrative in nature and not a barrier, in which case you can recognize that income, or if you believe that the SBA, their review and approval, including questions of your eligibility to participate based on economic uncertainty certifications that you've made, if the uncertainty is such that it's not appropriate. But I think that in and of itself, the SBA approval isn't necessarily a barrier, depending on your thoughts about the uncertainty that it may create. And be aware along those lines with respect to forgiveness. Just recently, the SBA drafted some forms, additional informational forms that you need to fill out to accompany your forgiveness application or be submitted shortly thereafter. The focus is on liquidity and really helping them target their review of the economic uncertainty certifications that were made as part of the application process. And it's not 100% clear how they're going to use that information, but we would advise that you really want to engage counsel to help fill that out if you think that there's exposure that based on the liquidity considerations, there might be a risk that the SBA will say the economic uncertainty certification didn't apply. You'll want to make sure that you make the strongest case possible as you complete those questionnaires. So, Jared, moving on.
Poll question time. So we're going to go ahead and launch that. And again, if you are attending for CPE credit, you will need to answer the poll questions. We'll keep it open for about 30 seconds here to give everyone an opportunity to submit their responses. Great. Keep it open for just about another few seconds here for any last-minute selections. Perfect. Thank you, everybody. Back to you, Marcus.
All right, thank you. So next slide. So as our industry leaders talked about what issues do they anticipate may have a more significant impact on the financial reporting cycle and the audit cycle this go around than they typically have, goodwill impairment considerations rose to the top of the list after PPP. And so we'll spend a few minutes talking about that and make sure that you're aware of some of the simplified impairment analysis that is now available. And certainly if you find yourself having to consider goodwill impairment, you'll want to apply, I would think, some of these simplifications that have recently been issued. So next slide, Jared. So just as a reminder, goodwill needs to be assessed for impairment at least annually or upon a triggering event. So it's going to need to be done. And next slide, you can see that certainly triggering events include deteriorating macroeconomic conditions, cost factors, pandemic, sustained decrease in share price, not likely for our private client base, or financial crisis. Any number of these items are likely out there these days and would trigger impairment analysis even if your annual process didn't require it. So next slide. And as a quick overview, the first step in a goodwill impairment analysis is a qualitative assessment where you're considering whether it's more likely than not that goodwill has been impaired. If it is more likely than not, you would then perform the first step of a quantitative assessment to determine whether the fair value of the reporting unit is less than its carrying value. And if the answer is yes, there will be some impairment in all likelihood. And we'll talk about how this process works in a bit more detail here. So next slide, Jared. So with respect to step 0, the qualitative assessment, again, what you're looking for and considering is whether there's a 50% likelihood that the fair value of the reporting unit is less than its carrying value. That's a subjective assessment, and it's based on factors including general macroeconomic conditions, industry or market conditions, impacts on your earnings and cash flow, overall financial performance, actual and compared to expected performance, entity-specific events, and or changes in share price. So that's the sort of thing that you're thinking of when you're trying to make a judgment call on qualitatively, is it more likely than not that impairment has occurred? Next slide. This is intended as a tool to help you document as you make that qualitative assessment, what are the factors that you considered, how did you weight them, and this can help you support your conclusion about whether it's more likely than not. There's no black and white here. There's not a scoring mechanism that a certain number of boxes in the unfavorable, neutral, or favorable winds up with any specific conclusion. But when you document your consideration of some of the specific factors, along with your assessment of the importance of each one of those, this can help you support your assessment of whether or not you passed step 0. So moving on to step 1, if you do have to move on to an impairment analysis, step 1 is a quantitative test. And again, this is just do you believe that the fair value of the reporting unit is less than its carrying value? Now you've got to think about how to calculate fair value. And that can be done a number of different ways: discounted cash flow models. You can look to guideline public comparables, different M&A transactions that may be observable in the market price, and a comparative to market cap for comparable public companies. If you've had recent capital infusions from third parties, that may provide some information. But this starts to become a complicated exercise that, depending on the expertise that you have in-house, may require the input from some valuation specialists. So step 1 is just overall fair value compared to carrying value. Next slide. This is where the most important simplification has come into play. Prior to ASU 2017-04, if you failed step 1, you had to move on to step 2, which, without getting into the details here, really effectively required you to do something akin to a purchase price allocation that you would perform upon it as if a business combination, an acquisition had occurred. And that would include identifying and valuing previously unidentified intangible assets. That's a complicated process, likely requires valuation expertise. So it can be time consuming, it can be expensive. ASU 2017-04 simplified that and said, well, what you can do is, to the extent that the carrying value exceeds the fair value of a reporting unit, that's your impairment. So you would write your goodwill down to the extent that that excess occurs until goodwill equals 0. If the fair value of the reporting unit exceeds its carrying value, you're in the clear. So that's a much more simplified analysis. It's not required to be applied until, next slide, Jared, until fiscal years beginning after December 15th, 2021, but there's no reason not to early adopt. If you find yourself going down this path, it really should make your life a bit simpler. So next slide, polling question.
All right, we've got polling question number 3 here. Let me go ahead and launch that. Keep it over in for just about another 10 seconds here for everyone to get their selections in. Perfect. Thank you, everybody. Back to you, Marcus.
All right, so let's move forward. So accounting for lease concessions. This is one of another area where the standard setters, the FASB, stepped in and tried to provide some relief in the form of simplification for an accounting issue that was not, probably when the standards were written, it wasn't expected to be as widespread, and that is lease concessions. So move forward. So the FASB, what they've done is they've issued a Q&A with respect to lease concessions. And so what we're talking about here with COVID-related lease concessions is changes in scheduled lease payments that weren't stipulated in the original contract. Those are, well, I guess those are generally treated as lease modifications. If you have a contract that includes requirements for lease concessions under specified circumstances, that's already in there, would not be, it's already in the contract, so it wouldn't be treated as a modification. Slide. So what we're focused on here is concessions that weren't stipulated in the lease contract. Those would have been accounted for as lease modifications. However, if those modifications are specifically related to the effects of COVID-19, there are some alternatives in place that can reduce the cost and complexity of the analysis. And again, this is because the FASB, when the original literature was addressed or developed, it didn't necessarily anticipate the scope of changes that might be brought on by a pandemic, which we are now living through. So next slide. So the first question that in the FAQ provides an alternative to COVID-related 19 lease concessions. And you have an election to treat them consistent with how those concessions would be treated if they were enforceable rights and obligations that existed in the agreement rather than lease modifications. And that's true whether or not those rights existed within the original agreement. So next slide. So again, this is only available if the concession does not result in a substantial increase in the rights of the lessor. It's got to be a relief to the lessee. So if it's increasing the rights of the lessor or obligations of the lessee, that's not the type of modification we're talking about. It's got to be a concession. So essentially, total payments in the modified contract should be substantially the same or less. They shouldn't go up. Next slide. So if that's the case, the deferral of lease payments with no substantive changes to consideration there's two methods to account for that. So we're talking about really deferring and tacking on to the end of the lease. a missed payment. So you can account for those as concessions as if there were no change in the contract, and basically recognize the amounts in the income statement during the deferral period with a corresponding increase in receivable or payable, or account for the deferred payments as variable lease payments and record them when paid. So you have some options to elect there. Either one of those is appropriate based on this Q&A. The second question addressed says that the entity can continue to account for concessions as lease modifications, so that the existing gap could still be applied, but you do have some simplifications available. Question 3, if you've got multiple leases, do you have to take these simplifications and apply them across the board? No, the answer is you don't, but you need to account for all leases in accordance with all leases with similar characteristics and circumstances should be accounted for in the same way. And finally, question 4, you need to disclose in the financial statements the impact of the accounting policies that you've undertaken. Okay, the next topic that was on our list that we thought might have increased relevance in this time of uncertainty is accounting for contingencies, both accounting as well as disclosure considerations. And what we're talking about here is dealing with uncertainty, with potential losses. And I guess the first thing that needs to be clear is losses don't have to be certain in order to result in accrual and or disclosure in your financial statements. There's basically, you need to be thinking about the spectrum of certainty that a loss has occurred, and at the lowest end, if the probability that a material loss has been incurred may be deemed to be remote. If that's the case, no harm, no foul from a financial reporting standpoint. You don't have to accrue the loss, and no disclosure is required. So some of the challenges here are, this is a bit subjective. The term remote is not specifically defined anywhere in the accounting standards codification, but it's a pretty, it's low. Generally speaking, it's probably the 25 to 30% range. So it's got to be pretty low probability in order to conclude if there's a potential loss contingency that you don't need to have at least some disclosure, if not accrual. So next slide. At the other end of the spectrum is that the loss is probable. If the loss is probable, and again, this is a term that isn't precisely defined, I would say that in practice, you're really thinking about the 70 to 75% range to conclude that it's probable. And if it's with that degree of certainty that a material loss has been incurred, accrual is required. And given that it's an estimate, what do you need to accrue? If there is a best estimate, you would book that best estimate if one exists. If a best point estimate doesn't exist, but you've got a range, you would book to the low end of that range. If even a range isn't reasonably estimable, what you would do is you would disclose the nature of the contingency, and you would have to explain to readers of the financial statements why is it that an estimate cannot be made. And if an accrual is made, are additional disclosures required? It depends. It depends if there's if it's probable that the actual loss may occur, or reasonably possible, excuse me, that the actual loss may exceed the loss that you've accrued, or in any other way, is there information necessary to avoid rendering the financial statements misleading? So additional disclosure may be necessary. And finally, that leaves what's that middle ground there between, say, 30 and 70%, so roughly. That means that a loss is reasonably possible. And I would say in practice, we often wind up there. We often will, when we're thinking about legal loss contingencies, for example, and we're asking attorneys to input, they tend to be loath to opine on a loss as being probable. More often than not, what we'll see in their responses to us, which we use as audit evidence, is that they'll say that they're not able to conclude on whether the likelihood is remote or probable. That doesn't mean no further consideration is required. That means you're in this reasonably possible range. And if it's reasonably possible that a loss has occurred, disclosure would be required in the footnotes. Next slide, Jared.
All right, we've got our last poll question here. So just gonna leave this up again. If you are attending for CPE, you do need to answer all of the polling questions. So this will be, I believe, our last one of the webinar. So keep it open for about 30 seconds here to get everyone's voting in. Great. Thank you, everybody. Back to you, Marcus.
All right, thank you. The last topic that we're going to dive into in a bit of detail, and then we've got sort of a quick list of other considerations that we'll have you thinking about in case they apply to you. Unfortunately, is going concern. We see it in the headlines every day. A lot of businesses are struggling, and organizations that have never had to really seriously consider going concern considerations in the past may have to do so this year. And these can be very challenging, very subjective, very judgmental analyses that are required, including forward-looking analysis and estimates. So it's an area of complexity. If you think that there's that you may be going down this path, or there's a need to assess whether going concern should be considered, that conversation and dialogue with your auditors and your management team really needs to happen and begin sooner rather than later to make sure that everybody's on the same page. So next slide. So the literature about going concern changed a few years ago. In some respects, it became a bit more onerous in a couple of respects. One is it used to be an audit issue only. Now, because of the disclosure ramifications that have been codified, it is the actual assessment is management's responsibility. Management needs to assess whether substantial doubt exists about its ability to continue as a going concern for a year beyond the date at which the financial statements are available to be issued. That last sentence there, that last piece is critical. It used to be that the analysis period was a year from the balance sheet date. So the more time that went by after your, let's say, 12/31 year end, as 12/31 of the subsequent year approached, the less uncertainty existed. And in some respects, that made the analysis easier to conclude upon. Now, if you wait, it's 1 year from the date that the statements are issued. So that when the report is dated, essentially, and if you wait and let's say April, May, June roll by, you're no longer looking, the analysis time frame is not going down from 8 months to 6 months to however long you wait. It's always a year. So if you waited until, say, June 30, 2021 before you were ready to issue the statements, you're not just looking ahead 6 months. You're looking ahead to perform this analysis through essentially July 1st of 2022, if you went down that road. So it's a challenge, and you've got to look forward beyond even the upcoming fiscal year, which may be the extent that you've actually formally budgeted for. So next slide. So if you conclude that conditions exist that indicate that it's probable that management won't be able to continue as a going concern, you then need to continue what is the mitigating effect of management's plans. And that really is a two-part question. And one is, are you able to conclude that it's probable that management's plans will be effectively implemented within 1 year after the date that the statements are going to be issued? So is the plan implementable? Or is it wishful thinking? Is it realistic? Can we do it? And then the second part of the question is, if it's realistic, is it probable that once implemented, it will have the effects that are intended, which is to alleviate that substantial doubt? Moving on. So what are the disclosure requirements? So if the substantial doubt is alleviated after considering management's plans, you still need to disclose the considerations involved here. That what were the conditions that gave rise to substantial doubt before consideration of management's plans? And then what is management's evaluation of the significance of those events? And what are the plans that alleviated that substantial doubt would be a required disclosure. Moving on. And finally, if the disclosures, if management plans do not alleviate that substantial doubt, the same disclosure exists as we just described, except the last bullet point, the entity should also include a statement indicating that there is substantial doubt about the entity's ability to continue as a going concern within 1 year after the date that the financial statements are issued. So that's a challenging analysis. If it needs to be performed, it's best not undertaken when you're hoping to get the statements out the door next spring, and this is the last item on the checklist. So start those conversations sooner rather than later. So a few other things that may be relevant this year that haven't been so important or so consequential in the past. The first is the impact of changes on internal controls and fraud risk. Is if you've pivoted to remote environments where the way that you process and record transactions has changed, or if you've had headcount reductions as a result of the pandemic and roles and responsibilities have changed and been consolidated, you need to consider the impact of that on fraud risk or the risk that an error may occur. And this is certainly something that your auditors will need to be considering. And so for your own good and as part of maintaining a sound internal control environment, as well as supporting the audit, might be smart to document what changes have occurred and what's our conclusion with respect to the risk that a material misstatement may occur. That may serve as a roadmap to help get the auditors through this analysis as quickly as possible. It's also something that, probably more importantly, is important as you run your own business and ensure that internal controls are adequate. Other issues that may come to bear, discontinued operations. If you have shut down a branch, if you've shut down an operation, exited a geography, does that qualify for discontinued operations reporting, which can move the net income associated with that component of your operations down below the operating measure? And just as without going into too much detail, it only qualifies if the discontinued operation constitutes a major strategic shift. If it does, it may qualify. Major strategic shift is another one of those phrases that's not very well defined in the standards, but if you look to the examples that are given in the standards, it's generally, significant. Major strategic shift is usually measured as 15% or so of revenue, net income, that sort of thing. So it's got to be a significant change in your operations, though it's not black and white. Other things to consider: compliance with debt covenants. Certainly, if you think that COVID-related expenditures or lost revenue are likely to result in violation of a debt covenant, start those conversations as soon as possible with your bank. Some lenders are more flexible than others with respect to their willingness to exclude from different covenant calculations the impact of COVID. Often we see in debt covenants that a debt service coverage ratio, for example, may allow you to add back extraordinary items. Just bear in mind, extraordinary items no longer exist in GAAP, so there's no question of using that as a mechanism to add back COVID-related expenses or lost revenue, because that term just doesn't exist anymore for generally accepted accounting principles. Other considerations would be impairment of long-lived assets, including property, plant, and equipment. That's a function of undiscounted cash flows associated with those assets. Finally, restructuring costs and termination benefits. Restructuring costs generally would be accounted in the period that they are incurred. Termination benefits can get to be a bit complex if you have terminated personnel. The question is, at what point should those termination benefits be recognized and accrued? And it can depend on different factors, including whether or not future service is required through some point in time from the terminated employees in order to earn some sort of bonus. It can get to be, there's a number of different factors there. So if you have laid off employees and paid out some termination benefits, particularly if it was near year end, that's something to put on your radar screen and make sure that you are talking about both internally as a management team and with your auditors to make sure that everybody's on the same page. So with that, we're near the end of the hour. As I said, we did have some PPP related questions. that I did not address. Those were primarily mechanical in nature. We will try to get back to you. We're not ignoring you, but we've taken up the hour. Thank you. The risk of taking another hour of your lives and talking about COVID, certainly not going away, is going to impact the way that you close the books, the things that you're having to think about. Hopefully you found this to be helpful, and we're certainly available if it's prompted any additional questions. So thank you.